Alrighty, let's go ahead and get started. Welcome everyone to the HUBB Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the excuse me, in the United States. So nothing is to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, I'm not even sure I need to say it. I'm sure everyone out there is aware. It's all eyes on Nvidia after the close and their earnings and how that's going to impact the tech sector and just overall implications in general. So very excited to get into that discussion with Rob. And of course, very excited to interact with you all. So let's go ahead and kick off. Rob, you out there?
I am Zach, and I know you're under the weather, so appreciate you powering through this as well. I clearly can hear the congestion in your voice, so hopefully you are feeling better. Maybe Nvidia's earnings will make you feel better today, and everyone else that's watching that after the close today. It's going to have a lot to do with not just Nvidia, but the whole AI tech sector, the big seven, mag 10, whatever you want to call it, how far you want to branch it out. But um, it seems like lots of people curious as to what NVIDIA is going to say. Nobody expects them to disappoint on numbers, but with valuations, they need to do a little better than um, just barely beat expectations. Then, of course, in the conference call, some people on the financial networks today have suggested that really the number isn't going to matter that much. It's going to be Jensen Huang's um, conference call after the earnings report and what he has to say about China and China's new nationalism on encouraging companies to use Huawei chips and chips made in China. So, yeah, that's all we've been hearing about for 2 days, pretty much going back to Monday. So, almost all week, we've been hearing about Nvidia. So, we're finally here and we can get past that after the close. Taking a look at the chart, you can see the chart has really just leveled off here on the S&P. We got up in that 650 area, didn't quite make it there yet, but in the neighborhood. And then for the past 2 weeks, basically, been bumping our heads in the 645 area or so. It will probably take Nvidia beating earnings and guiding higher. Guidance will be watched as well, and for any signs of how they feel selling chips into China could affect things moving forward. So a lot of things that'll be watched other than just what the headline number is. And then I've been talking over the past week or so on the surprise of Chairman Powell's slightly more dovish tone on Friday during the Jackson Hole summit. And the expectation is now back on the table for a rate cut in September. And so the conversation is going back and forth on the financial networks on whether it'll be 25 or 50 basis points. I don't think it's 50 basis points. I would be shocked if they did that, but I think it's likely that we're going to see a 25 basis point rate cut. Some people have thought that this whole Lisa Cook thing could be a distraction as far as the Fed being angry about it and whether or not they will actually cut in September. These are all just talking points that the financial networks love to play on. And so the reason that I talk about them is try to explain to everybody what's really going on and break it down into a more plain English standpoint of the implications of all the stuff that you hear about day in and day out. So if we do get a rate cut, and I think we have to wait till September, we could creep up, break this 645 resistance here that I've drawn again, and then have a little bit of a FOMO moment where we have that vertical move. And if we do get that, and as I said, it may take till the Fed meeting, which again, I believe is September 16th and 17th, could be off a day or two on the dates, but I think that's when it is. It's a 2-day meeting, so we won't know till Wednesday afternoon at 2 p.m. if they cut rates. Since it's a 2-day meeting, there will be a press conference from Chairman Powell afterwards, and no matter what they say, he's going to get asked a lot of questions about it. So perhaps that's the catalyst for the big move higher. And I've wondered if that's going to be a buy the rumor, sell the news moment. In other words, we get the big spike up. The Fed's finally cut earnings. It's official now. We get a big spike up, and then maybe at that point we start some sort of a corrective phase towards the wave 4. Just an opinion for whatever it's worth. I think that the expectation of a rate cut has somewhat been built in through this rally, that the Fed will cut at some point in time. It was just a little over a week ago, or maybe, yeah, it's probably closer to 3 weeks ago now. Time goes so fast. On the non-farm Friday, that we wondered if we would get a rate cut at all this year. So yeah, it's just been all over the place, and we just want to get it done, get the Fed's take on their outlook for the rest of the year as far as any other cuts. Most people feel there'll be one in September and perhaps another one in December. That seems to be the prevailing wisdom at this point in time. We'll see. Certainly, if the Fed doesn't cut in September, that would be a big disappointment to the market, and that probably creates the wave 4 move to the downside. So I think we'll break out of this ascending pennant pattern that we've been in, that just continues to continue and widen a bit. It was far more narrow before we had the non-farm Friday. And so then we moved it over here with that Friday's move. And then with the FOMC meeting, where Chairman Powell was hawkish, we got the downward move. And then 2 days later, or a few days later, he's far more dovish at the FOMC. And a lot of people are saying, well, he didn't have the non-farm number before. I don't know. We'll see what happens in a couple of weeks. But the important thing is, where do we go from here? Perhaps a little bit of a melt up, but I don't think we get that big FOMO spike higher or breakout significantly from this ascending pennant pattern without that rate cut in September. If we look at the VIX, still hovering around 15. It's where we are right now as we're speaking, right at 15. So we're holding in this lower end. Look like we might sneak out a little bit here and head down towards 12.5, but we didn't get the follow through day. You know how that works. You need to follow through a confirmation day. If you break a level of support, we didn't get it. So we're just teetering here right around this level of 15. And we just have this large descending triangle pattern here. It's really, that's not the actual way to draw it, because we would need to take in this spike high here, which would bring the line a little more shallow and take it out a little bit further, meaning that maybe we just churn here until we get to that September meeting. We'll have to wait and see how the VIX reacts. But for now, staying slightly elevated, but in the lower end of the range between 15 and 22.5, kind of going along with the market, just churning sideways at this point in time. Let's look at the bond market, which has been pretty interesting to me, with the fact that it hasn't seemed to be too confident on what the Fed is going to do with all of these triangles that we've had following this big wave 5 down, 100%, just a classic Elliott Wave pattern here on the TLT, where we had that 54%, so between 50 and 61.8 on the wave 4, yields 100% extensions, exactly where we went, and we've been just basically going sideways, forming triangles ever since. You can see that where we are right now is awfully close to those wave 5 lows. So we've had some moves up and down, but really have gone nowhere since January, since the January low there. And as a quick reminder, TLT is prices on the 20-year, prices and yields move inversely. So whatever you see on the chart of TLT, yields and rates are doing the opposite. So if we see a little bit of a tick down here, that means yields and rates are ticking up just a bit, at least on the longer end. So let's go look at the TNX, that's the shorter end of the curve, the 10-year, and this is rates on the 10-year. So TLT shows prices, TNX shows actual rates. And you can see rates have actually come down a bit. So we're starting to steepen the yield curve a little bit, which is a little healthier. You should get more interest return for holding a bond or treasury longer. When you have an inverted yield curve, that means you're getting more interest for shorter term maturities, which again is not how things are supposed to work. So this is viewed as being a little healthier economically. We did show the macro charts from the same folks at HUBB that give us the AI signals that we'll talk about in just a moment, that showed the economy is still in expansion. There is an elevated area of contraction, but it's not near where the expansion phase is. So even though certain areas of the economy may be contracting a bit, overall, the economy is still in expansion mode. And that's a positive as you're going into what's likely going to be a Fed rate cutting cycle. To already have the economy expanding and not contracting going in there could give that boost. And that's why I think we might get that spike up if we get the actual rate cut in September. So if we look at the dollar just hanging in there in Goldilocks land. You've heard me talk about this pretty much for the last 3 or 4 months. I think this range down here where this wave 5 ended, this trend channel right here is the Goldilocks scenario for the dollar, staying in the lower end of the range, but not breaking out significantly. There are some that have the thought process that if we do get the rate cut in September, that could break us out of this channel and perhaps start lower. You know my point on this by now. I've said it enough times. I really don't want to see the dollar come down here towards an extended wave 5 from where we've been. I wouldn't want to see that wave 5 low from early July broken. I just don't want to get to the point where any conversation becomes, is the dollar not relevant anymore? Is it not the currency of last resort for other countries? Will other countries start dumping dollars because they don't want to lose on all their holdings? All those types of comments would be coming out, and I don't think that's constructive for the market to go higher. So I wouldn't want to see that. You would want to see that if you want to see the market correct a bit. Not just a little bit, because a small move down in the dollar would be constructive for the markets to move higher. A big drop in the dollar would be where the concern comes in. So I just want to be clear on that. Just because we break below 97.5 on the dollar doesn't necessarily mean, oh no, it's bad for equities. That's still constructive for equities. I just don't want a big drop in the dollar. That's all. So we'll take a look across the markets at Dow. Just kind of everything's just pretty much treading water this week, waiting on Nvidia, their king in AI right now. And so lots of people are looking at that. You may have heard the head of OpenAI come out and say that feels like a little bit of a bubble, that maybe people are getting a little too ahead of themselves on the potential for AI. Not really sure how you can say that. It does seem to be the future, but valuations are high, so maybe that's what he's focused on. But they can stay elevated for a while. That's my problem with fundamentals. I do like seeing the macro charts. I do like the fact that the AI signals take fundamentals into account, but are predominantly technical. I think that's where you want to be. I like the way the data scientists at HUBB have set their things up. Obviously, they don't give us everything, is proprietary to them, but they give us a few nuggets here and there, so we get a rough idea of what the methodology is in creating those AI signals. And I think it's a good mix. And so another reason why I think those AI signals are really important. You're going to see similar things going on here. Obviously, we will see some sort of a move out of the queues tomorrow following what happens with Nvidia. It's going to drive not just Nvidia, but a lot of other stocks in the AI space. We do have, pardon me, a small triangle here. Not very significant, but a triangle nonetheless. And so we should get some sort of a breakout. And if we come over here and get the crosshairs, and we can get an idea. Remember, in a triangle, you measure the mouth of the triangle, the width of the mouth of the triangle. That gives you the idea of about how far you're going to break. So the low, call it 560, and then the high, we can round that up. It's 585. So it's 25 points on the Qs is the mouth of the triangle. So at some point, we will likely see the Qs move 25 points from where we are right here at 570. If we break to the upside and we go 20 points or so, near 25 points, hard to imagine we don't actually go all the way up and hit 600. That would be quite surprising. And maybe that's where we start to get the point where some selling comes in. There's been some market rotation, as mentioned a few times, away from some of the big tech. We are broadening out into financials, et cetera, which is healthy for the economy and the markets as a whole. You want the financials to be acting well, even though the market for quite some time has been focused on 7 to 10 stocks, and that's been pretty much it. But overall, in general, you want financials to be performing well. Financials tend to do well in rate cutting cycles. I heard a comment on the financial networks not too long before we started that said that they felt financials were getting overvalued. Don't tend to agree with the concern over financials right now. I don't think they're not valued anywhere near the way tech stocks are. I don't think they're overvalued that much. And when you move into a rate cutting cycle, financials tend to perform better there. So I do think financials have a little bit more room to run. Been looking at a few opportunities for alerts in that space. And then we go to the IWM up at 235. So we have broken above the 230 level and continuing to move higher, benefiting from the expectation of a rate cut. We've talked about this numerous times. Two big things to watch on the IWM. One, it gives you a good risk on, risk off view of the market. They're smaller caps. They don't have the staying power of the big companies in the Dow or even the blue chips in the S&P. So a little bit more susceptible to volatile moves. But they're also the market that's the most responsive to interest rates, cuts or hikes. These are smaller companies. They need to borrow money. They're investing in their own companies to grow them. And oftentimes that means they need to borrow money. And if money is expensive to borrow, i.e. rates are higher, they tend not to borrow as much, so they don't invest as much, they don't grow as fast. But when money is cheaper, they borrow more, they invest more, and their companies grow more. And that's why the IWM tends to perform better when you have interest rates ticking down a bit. So we finally hit the 230 level. I thought we were going to get there back in July. Didn't make it until August, and we finally got there. And then now we look to see, can we hit 240? Maybe we can get to 240 now. It's a possibility at this point in time. Tiny bit overbought from the 10-day moving average. And I think this will be a little susceptible to Nvidia, maybe not as much, certainly not as much as the Qs, but maybe not as much as some of the other markets. I think this is more going along the lines of what's happening with interest rates. Do they cut in September? And then we get to the energy sector. A little bit of a bid in UNG today. I think that's pretty interesting. We may, and you might see it this afternoon, a speculative alert come out on UNG. I've talked about this before. I think I've given a pretty good dissertation on what's up with natural gas. We get a lot of questions. Why can't it go higher? And it just boils down to how the markets work. In general, in a one-phrase statement, markets move on supply and demand based on fear and greed. Pretty much that's how it is. And at this point in time, we're the Middle East of natural gas, tons of supply, even though we know there's going to be increased demand. And now that the administration is coming out a little bit negative on solar and wind power, energy. It's going to have to come from somewhere, and I think it's going to be from natural gas. Maybe that can turn the demand enough to take a dent out of the supply and move the price higher. But I think the first move in natural gas is just going to be a technical one. We've been moving down since right after the beginning of the year, early spring. It's made a significant move down. And at some point in time, the sellers will become exhausted. And so anyone that's wanted to sell natural gas will have sold. And then you have even a small number of buyers, enough to at least get a bounce higher. And at this point, we've passed the 100% extension on the wave 5, so we are not looking for a retracement back to the previous 4. It could do it, but you don't expect it, or you don't look for it. What I'm thinking that may happen is that we get a reflex bounce off this oversold condition and perhaps come test this level around 15. So that's all I'd be looking for on natural gas. Oil, and keep talking about Led Zeppelin, and song remains the same. Just every time we've talked for the past few months, it's been the same story. Has been since the beginning of the year. The market outlook, the update for the second half of the year, still think that we stay in this big trading range throughout the rest of 2025. And I think OPEC Plus, whatever, likes this area of the USO trading around 75, stays slightly elevated. We're used to these prices at the pumps. It's not enough to drive new people into electric vehicles yet, but you get a big spike up in oil, and it could do that. And so OPEC is managing the supply demand curve, just as I was just talking about how that's the way the markets work in general. And each of the last 2 times OPEC has shown that we've gotten a spike, they've increased production to bring the price right back down. So it's Goldilocks for OPEC right now as well, with slightly elevated prices in oil, but not to the point where it hurts demand. Let's move to the metals. Gold, my goodness, is it ever going to break out? Well, it keeps trying and then falling back and building this triangle larger and larger. Maybe we get a bit of a continued move up in GLD. It's going to be real interesting to see where gold closes today. If we do get, perhaps we do get the breakout first. We're getting awfully close to being able to label this as a breakout, but we need to at least take out this high to show that we're not forming an even larger triangle. Technically, on the high, it's still a little bit below that high, which would be in a pattern of lower highs on the upper trend line. But perhaps we do sneak out to the upside. We're still on a point yet where we have to respect a potential downside breakout. I think if the Fed cuts rates and the dollar goes down a bit, that's going to spur gold significantly higher. Gold trades a lot with the dollar. And since the dollar has been just kind of going sideways for a while, so has gold. So watch the dollar if you want to have an idea of what's going to go on with gold. And that's where the issue is, right? Because you can look at the dollar being a bit lower, but if the Fed disappoints and doesn't cut in September, I think you get a bid under the dollar. And the dollar goes a little higher, and that could be a downside breakout of GLD. So there is an argument either way on what's going to happen with gold, the dollar, and the interest rate decision at the September meeting. They all kind of tie together. And then looking at SLV, kind of testing the breakout. Talked about this yesterday a lot during Trade Finder. I've mentioned during the insiders that we have a pretty well proportioned. I like symmetry in patterns within Elliott Wave, zigzags, etc. It's a real symmetrical wave 5 move to the upside, just kind of creeping up higher here. Formed a small triangle, nothing near the size of the triangle in gold, or at least the GLD. And I've mentioned this numerous times. There's 3 primary ways stocks break out of triangles. They break out and just take off and run, whether it's to the upside or the downside. They break out, test the breakout, and then run. And then the third is that you get a false breakout. It looks like we're going higher. We didn't get a follow-through day on that breakout day. And so you still have to respect that that could break to the downside as well. So it does look like, pardon me, both gold and silver want to go higher. We can't make that call yet, though. Looking at the charts, maybe in a couple days we can, and maybe it's going to take that PCE report that comes out, and if that is on the tame side, that pretty much I think submits cements the September rate cut. But if that PCE report's a little hotter, that's the inflation report that supposedly the Fed values the most. um, Personal consumption expenditures index is what PCE stands for, then that could give the Fed or move them back to pause and not cut in September if it's too hot, or again cement that cut in September if it's anywhere close to being in line. Doesn't even have to be weak, just in line, I think would be enough with the way the Fed's talking now. And you can see that if we continue with this same symmetry that we've had here, you could easily see the SLV move into this wave 5 tap box here. The wave 4 right at the 38.2% level, that support level created by the AI's forecast back in June, as well as the 50-day moving average. All those things converge to form that wave 4, the 38.2% fib retracement level, being a primary one happening to intersect with the 50-day moving average, but not convinced yet. The bond market, the metals market, nobody's wanting to really step in and say, yeah, the Fed's going to cut in September. And why would you, with the way the Fed has been acting, where they seem hawkish, then a little more dovish? It's hard to know. And then when we go to cryptos real quick, as has been recently, Ethereum outperforming Bitcoin, at least looking at the ETHW, a good way to trade options on Ethereum through this ETF. You get the leverage of options that we enjoy so much, and you have an opportunity to do it with Ethereum as well as Bitcoin. So just when we got into danger, Will Robinson land here on Bitcoin, where we could have come a lot lower, at least on the BITB here into this trend channel, testing that point of the triangle breakout back in June, or even lower down to 55. We broke below 60 and no follow through day yesterday, and we're back up testing the 50-day moving average today. So maybe we're set for another run there in the cryptos. But yeah, it got a little dicey there for a day, but they managed to hang on. I always use that analogy of your fingernails hanging on the edge of a cliff. Well, they were able to pull themselves back up, at least for now. Let's go ahead and take a look at AI and the AI signals. Lots of bullish signals, as you may have noted, very few bearish ones. The scores haven't been very high, though. And in the past, when the AI signals have done this, it's been the right thing. Just be patient and wait for the signals to get a little bit stronger. I think what the bond market, the dollar, interest rates are all talking is the uncertainty, the metals, with what the Fed's going to do in September. And it's more of a wait and see scenario. And that's being reflected, I believe, in those AI signals. But I did want to go back a couple days on the bullish side, because I think there's some that are quite interesting. If we go back previous day, you can see we had symbol here on Frisia, which has to do in the healthcare area, I believe. And we've had a kind of a vertical move here, only a 61% rounded up score here, and 2 vertical. So not something we would want to touch, a big vertical move like that with a lower score, but interesting nonetheless that it's doing that. I know some of you, our subscribers, have asked about XLV and the whole healthcare sector. I think that Nvidia is going to have a lot to do with what happens in the healthcare sector. There has been a little bit of rotation in that area. Um, we've looked at Costco, which is in a downward move, but Kohl's reported good numbers. So you can see Walmart had decent numbers, that some consumer spending habits have changed a bit into the discounters. Costco just doesn't seem to be participating so much. But then we go down here and we start looking at these low signals for potential fade trade. And you have a signal down here around 5, but it's a REIT. And I don't like trading REITs, even if they have good open interest. Just like I haven't liked trading drug companies. We all know, if you've been in the insiders meeting, we talk about we don't do drugs. It's the worst alert we've ever had was a drug company stock. And so they're just very hard to predict. And REITs are right there behind them. They tend not to move much, as you can see right through here. And you might think, well, then why aren't REITs great for the time strategy? Well, because they do this kind of stuff a lot, you don't get a lot of premium. So there's not really enough premium in order to take advantage of from a calendar spread or a butterfly or something along those lines. So then let's go back another day. We'll go back to Friday's results. I think this one is quite interesting here. It was a bit overbought, but you can see it's consolidating rather nicely now. Barrick Mining, obviously used to be Barrick Gold, but if we do get an upward breakout in gold, this could follow. It's interesting that some of the mining stocks, we looked at a couple others yesterday as well, seem to be leading gold, which is usually the other way around. The miners usually follow what gold does, not lead. So that's quite interesting. Perhaps they're already thinking that there's going to be a move higher in gold. They've done well on earnings just with gold's run that it's had already before the sideways consolidation. That's been enough. But do we continue to go higher? I think we need gold to go higher. But this sideways consolidation that we've had, you can see we were just too overbought when the signal came out. The wave 3 is still the active wave, as evidenced by the algorithm from the HUBB organization and the HUBB software. So could we continue to go higher? I wish there was a zigzag in here. I'd feel better about that. I'd feel better if the score was above 70, but I think this one's quite interesting, and you may see an alert on this as well. It's pretty liquid on the options. That might come out this afternoon also, because I was waiting for this, and then we get the upward day yesterday, and like, maybe we're not going to get the consolidation and let the 10-day moving average catch up. Because as you know from these AI signals, even though some of them are overbought, when the signal comes out, some just continue and run. Nothing stays overvalued for long, as you know, but sometimes it's long enough to hit the target before the correction. And then other times we correct immediately or go sideways before the next run. But I like the setup on this one. The DMI here is supportive of a continued move higher. You can see there's been a little bit of a move down, but just as a reminder, which again I like to do, throw in other things during this HUBB Live session rather than only the AIs. You can see the positive directional indicator is ticking down a bit, and you might be wondering, is that a negative? Well, not surprising with the fact that the stock's been going sideways. But the key here, as a reminder, I talk about this as much as I can. When you see that, you want to look at the negative directional indicator as well. It's a different signal if you're having a tick down in the buyers or the bulls, which is the positive directional indicator, and a tick up in the negative directional indicator, which is the sellers or the bears. But when you see a tick down in the green line or the positive directional indicator without a tick up in the red line, it just means the buyers have paused a bit. So they're taking a little bit of a break. It's a different signal than if you see them converging back together. And the ADX is only around 35, so it has more room to run there. So still very supportive DMI, even with the couple, 3 days of consolidation here. I think this one sets up quite nicely. Looked at TTE as well. The signal wasn't quite high enough. I know it's only a couple points lower than B, and here's one that came down to test the 50-day moving average. But notice the difference in the DMI between the two. You cannot call that a supportive DMI for an upward move in any way, shape, or form. And look what's happened to the stock. We've come back down. Now perhaps we hold the 50-day moving average and we turn and run, and then maybe the DMI sets itself up and becomes more supportive. But for now, just looking at that is why it's a piece of the puzzle on whether or not we send out alerts or not on specific situations with these AI signals. All right, so let's take a look on the bearish side. We're not going to see much on the lines as we continue to move back forward in the calendar. And we had one here on PAM, but it's only a 47% score as an ADR. So this is a international company. ADRs, if you're new to that term, those three letters is American Depository Receipt. Basically, it's a manner for trading foreign stocks on the U.S. markets. Is the way they set them up with ADRs. Only a 47% score, but it does look like it wants to continue lower here. And the DMI is setting up, but the ADX would have a ways to go. And that's why I talk so often on the fact that I don't look at the DMI for the downward moves in the same manner that I look for the upward moves, because this is what happens. It's a good example of it. Oftentimes, the downward move that's expected is done before the DMI confirms the move, because the DMI, at least the ADX part, is a lagging indicator. The positive and negative directional indicators are more responsive to day-to-day movements in the markets, but the ADX is a little slower. And so that's why I don't pay so much attention to it. But I do like to look at the CCI on downward moves to see what it's looking like, because the CCI, which is the reason it's in the mix of our technical indicators, you can find out more information about the technical indicators that we use by going to the website in the education area. The CCI is very responsive to day-to-day movements, so it balances out the fact that the DMI is a little bit more lagging. And you can see there's a little divergence here. We made almost the same extreme point low as we made back in April, managed to make a slightly higher low, which is meaningful when you're taking a look at the CCI. It works just like anything else would as far as higher lows, lower highs, higher highs, all the things that you look at with trend lines. The extreme point low, just creating a slightly higher low. It's moving up, as you can see. I love the shadowing effect that the HUBB folks use on the CCI, especially since it's an indicator that I like. It makes it very clear whether or not you're above positive 100 or below negative 100, which is kind of the range with the CCI. Once again, you can find out more information in the education area on the Evo Trader website. But that would be another issue here, wouldn't it? So slightly different signal there than what we're getting from the DMI, which is why I like to look at the CCI on downward moves. This would be a bit of a divergent signal, slightly higher extreme point low, trending up towards negative 100 on a stock that is expected to go lower. Part of the reason, in my opinion, it really isn't, but it ties in. That kind of divergence is not one of the 300 data points that the data scientists use, but it ties in with the fact that the score was only 47%, that it's going to come down and reach that target. So less than a toss of a coin on it, and the CCI should keep you out of that if there's any temptation from the look of the chart. Coming back into last night's list, we did have KDP, but again, just a toss of a coin. And, you know, they just bought Um, is it Peeps? Pete's Coffee, Peets. So Keurig Dr. Pepper is branding, widening their brand, I guess, so to speak, into a big coffee manufacturer. You see it in the grocery stores. And this is what happens when a company buys another company, and it's a huge valuation, billions of dollars, which surprised me. I didn't realize that Pete's was that big. If that's how you pronounce it, I'm pretty sure it's Peet, apostrophe S. But you spend a bunch of money and you can argue whether they overspend or not. That'll come out in the long run, but traders don't like it when companies acquire other companies. This is usually what happens. The company is doing the acquiring, normally, not always, sometimes they get rewarded when they think, wow, that was a great buy that they made. But most of the time, when a company is acquiring another one, they go down, the company getting acquired goes up. And you can see that's what happened here with this big move to the downside. Does it creep all the way down to 28? Maybe, but it's way oversold at this point in time. Big gap down, big vertical move. We don't want to touch that either. So it's just always interesting to look at the charts, see how they turn out. Most of the time, the rules that we follow um, work. That's why they're rules. But I just thought I'd show you that because I found that to be quite interesting. Before we go to the Q&A, let's take a look at the sideways results, and nothing really going on here. You can see NEGG, which has a low score here, 15% on staying sideways. So again, the fade trade on that is the likelihood of it breaking out, not staying in the trend, but breaking out. They don't make huge moves. So sometimes it's more in a 25% profit range rather than the 30 to 70% that we usually look for out of a strangle. But interesting nonetheless. And so just out of curiosity, you go to look for options, and that kind of quells that. Nothing to look at along those lines. We'll go back a couple days here as well. You can see that we had DFDV, DF, DEFI development. That one looks pretty interesting, but it's a low dollar stock. But you sure like that 88% score, but that is concerning on the movement. Can you get enough premium? So you go look at it. We're looking at 15, and we're kind of ticking down there. It's becoming interesting. The September monthly option on the 15 strike put still has $1.50 of premium. You can see good open interest there. This could come out in the time strategy as well. So we're probably going to be pretty active as soon as we close off this session on alerts. But then we can't just stop there. We need to go down and look at October for the long side of a put calendar and make sure that we have enough open interest there, which we do. So you can see 250 by 285. So that one looks pretty interesting. In first blush, when you see a lower dollar stock, you worry if there's enough premium. But in this case, it seems like maybe there is. And this tick down today could be the ideal entry for that. So with that, Zach, I've been rambling on a lot. We're already at time, but I do want to open it up for some questions because we did spend some time talking about Nvidia, et cetera, which really isn't in the normal course of business on this AI show.
Yeah, no worries. Let's get right into it. I do want to quickly just announce and notify anyone that might not be aware. We are still dealing with issues from our third-party messaging service for the SMS alerts. I'm just getting a couple messages around not receiving the SMS alerts. Anyone who's located in North America, so anywhere in US or Canada, are temporarily not receiving the SMS alerts, and that's not from our control. That's from new regulations and policies that have been implemented in North America for messaging services across the board in this sector. So we will continue to keep you updated on that. There's been a few different posts on that, and I'm happy to respond via email for anyone that would like more details. But just know that we are diligently working for a solution there and looking to implement a app that will take the third-party messaging system out of the picture altogether and have just straight push notifications. But one last thing to wrap up my uh, ramble here is that you can always enable push notifications on your phone for email, so that would come through with the same details, actually more details than a text would for the alerts as well. So anyways, let's get right into some questions now. A question from Billy, LLY, where will support be at 38% or 50% retracement?
Well, I'll give you my best assessment here, but don't know for sure. I do think that, and I hate to put the entire market on Nvidia's back with their earnings tonight, but it does go along the lines of rotation. Um, Lilly has been doing extremely well. We've now filled the gap. Um, we dropped down here and didn't quite make it all the way down to the bearish target. And that's why we don't do things with a 55% score because of that. And back up, filled the gap, back to the 50-day moving average. We're at 750. If Nvidia does reignite the big tech AI hysteria that we've had by guiding higher and coming in with great numbers, maybe saying something positive about relationships with China. A lot of people feel like they're not going to talk about China until maybe the conference call afterwards, but it won't be in the actual earnings. Pardon me, news that comes out. So I think my long-winded answer here is the likelihood is that we're going to bump our heads here against 750, and perhaps that stays in place until the Fed meeting. We'll get a little bit of an idea of whether or not rotation continues. If the Fed doesn't cut at the September meeting, I think you're going to see money move back into healthcare, et cetera, for a little bit of a safe haven type trade. So my expectation for now would be perhaps a trading range following this reflex bounce here from oversold conditions into this trading range. So I think we kind of stay range bound here until the September Fed meeting. They disappoint. I think we could break out to the upside. If the Fed does cut, I think you're going to see money piling more into tech, AI, small caps, et cetera. Maybe not so much into healthcare and drug company stocks, and could be range bound for even longer than that. We might expand the range up to around the 800 level, but nothing from a significant standpoint, I don't think.
Thanks, Rob. Next up, we have a question from Maria. She says, basic question, how do you measure the extension from wave 4 to 5? Can use RCL, current pattern, as an example. Thanks.
We'll take a look at RCL. Um, Royal Caribbean. Man, there was pent-up demand coming out of COVID for the cruise lines. Then they went through a little bit of a corrective phase earlier this year, and then they're back on fire again, the cruise line stocks. So measuring the 4 to the 5, basically what this percentage means is how much has the wave 5 moved. So basically, how far is this movement from where the 4 is to the 5 in relation to the wave 3? So right now it's moved 35% of the movement in the wave 3. That's what the wave 5 is measuring. So yeah, you look at the number there rather than using a fib retracement or extension tool. You just look at that number and know that that's what it's measuring on the Wave 5, if that's what the question was, if I understand it correctly.
Yeah, Maria said thank you as soon as you started. I figured it out. So
Okay.
yeah, good explanation there. Question from Chris, J and J. If I calculated the Wave 3 zigzag correctly, it hit 100% and pulled back. Is that correct? Where do you see it going?
Let's take a look. Um, And, there is a little subjectivity to where you start the zigzags. And so I like to draw them from what was the start of the new impulsive move. So I would draw it here. Someone might make an argument of starting it at the low end of that bar. But I count that bar as part of the impulse move. So that gives us right at around a 38.2% retracement up to the 100% level, which it made it to. So I'm assuming that you've drawn it the same way. And we've got a bit of a doji here. Now, the issue with J&J, same thing as we were talking about with Lilly. So all the comments I just made about Eli Lilly apply to J&J as well. Um, Maybe a little bit broader with some other products rather than just drugs, et cetera. But when you have a 38.2% B wave correction, the first target 61.8, which it hit back here in early August. And then if you get an extended move, that would be 100%, which is where it went. So it's already had an extended C wave. So we've had one extension. Sometimes we get two, um, but not nearly as often as you get one. Oftentimes you do. And then you look at the CCI or the DMI, excuse me, and you can see that we got above 40 and we're ticking down. Here's that difference that I was talking about between the two directional indicators. Sometimes buyers just take a break, but the sellers don't feel emboldened and step in. It's just more of a, they call it a buyer's strike, but it's just more of a pause. But you see a little bit of interest from the sellers. Sometimes they kind of just dip their toes in the water and test things out. Because remember, shorting stocks is the riskiest thing you can do in the world of trading. So short sellers have to be real careful, and that's why they tend to um, do little small tests just to see, does the dip get bought into. And that's been a problem for short sellers, is this new crowd of retail traders post the COVID era are deeply programmed to buy the dip. It doesn't matter what the dip is caused by, just buy the dip. At some point that won't work, but for now it has been, and they're programmed that way. And so you wonder how much higher this can go. So with a big run like this already, and the fact that the AEX seems to be saying that, hey, that might be the end of that run, we could probably get a little bit of a move down. But it sounds like you drew your zigzag spot on. So good on you for doing that, because that question comes up a lot. Where do you start the A wave in drawing those? And so that's why I wouldn't start it down here. Because, yeah, we moved higher, but was that a strong impulsive move? No, it was kind of a drift higher. Bam! Clearly, the gap up and big bar, start of an impulsive move. At least to me, that's clearly the start of an impulsive move. So there's a little bit of an art to where you start the zigzag. But I think over time, practicing, and again, sounds like you nailed it. You start to figure that out just through trial and error over time.
Yes, indeed. And that actually wraps up all the questions for today's session. So thank you all for joining us for the live session as always. And I'll pass back over to you, Rob. Actually,
Sounds good.
there was
Um,
a comment that just came through. Um, said, thanks, good info. Trying to catch the bounce for KDP, expecting a big rebound up. Not a complete gamble since Pete's coffee is very popular and delicious.
oh, okay. Not. I drink coffee every morning. I see it in the grocery store all the time. It hasn't been. I've been, for whatever it's worth, I kind of go to the Newman's organic coffee, but I'm sure they appreciate your endorsement of the taste of their coffee. Obviously, Keurig Dr. Pepper agrees with you because they spent a heck of a lot of money to acquire them. And I think you're probably um, right there that um, there's probably an oversold bounce coming here. But remember, those are short-lived, so don't hang around too long. They don't all do what Eli Lilly did, which is immediately go back and fill the gap. Um, I would have thought on Eli Lilly that that might have been the end of it before this continuation move. So you catch a couple days here and then you get out. You would have seen a nice influx of implied volatility in the calls on this bounce. And then as it went sideways, that IV would have come back out. So you still would have gotten some benefit out of this continued move, but you would have lost that IV that came on 3 straight big up days. So that's kind of what you're trying to catch on those reflex bounces. So good luck. I'll be rooting for you on that KDP one. I think it's a good from a risk to reward standpoint, which we all know that's what markets are. That's worth a shot, I think, with his verticals that went down and as oversold as it is, and the fact that it's just they're buying another company that's a good company. It's not that something really bad is happening to their company. You know what I mean? So yeah, I think you've selected a good one there. So good on everybody that was here today. Good questions. Good job on drawing your patterns and the stocks that you're looking at. Proud of y'all. So thanks for spending some of your time with us during this trading day. Going to try to get a couple of these alerts out and then pull up a comfy chair and see what Nvidia has in store for us for the next several trading days, if not the next couple of weeks. So enjoy your afternoon. 4:20 p.m. Is when the number comes out. So it's not exactly after the close like some of them do. It's supposed to come out at 4:20. So just so you know, um, I'll leave it at that. Enjoy the rest of your trading afternoon, and I'll talk to you all Thursday night. Take care, everybody.